Welcome to the free session on IS 11. For the purposes of this video, we shall be discussing IS 11. So first of all, we need to understand what exactly IS 11 construction contracts is all about. For FR, this difficult subject, it is very important to learn from the basics. Otherwise, it will be difficult to comprehend the accounting standard. So first of all, as per IS 11, the basics about a construction contract is that it is the two parties come together. One has to get something constructed. The other one undertakes the responsibility of construction. It could be a construction of a single asset or maybe a multiple assets combination. For example, let's say I come and give you a contract to construct a school. So it will not only be just a school building, probably a library, the infrastructure, others for sports and other things. So wherein it is a combination of assets. And of course, if I'm trying to build a school with so many assets, I would usually try to use the same kind of a design and same kind of a technology. So I can conclude by saying that it is a contract between two or more people wherein one takes the responsibility of a construction of something and the other one is the one who wants to get something constructed. Broadly speaking, there are two types of construction contracts. One is a fixed price contract. Now, before getting into the terminology, look at the English word fixed price. It means that the price is fixed for the entire contract. Or if I am constructing something in units of output, probably I have a fixed rate per unit. Now, since practically these construction contracts are run over 4 to 5 years at times or even more than that, in 4 to 5 years of time, the prices of the raw materials could change. So the fixed price could no longer be beneficial for the one who is doing the construction. This is the reason they often have an escalation clause for the construction contracts, that in case, for example, I'm building a bridge, so if the cement price changes, then accordingly my fixed price will also change. This is very important to protect the contractor. Okay. The next is a cost plus contract. Again, the English term cost plus. It simply means whatever is your cost, I'm anyway giving you that. Plus, I'll be giving you a percentage, maybe of cost or a fixed fee as profit, whatever it is. Because nobody will work only on a cost to cost basis. There would always be some kind of a percentage involved as profit. Okay. Now, in construction contracts from accounting point of view, with the main problem comes in recognition of income since it's a long-term contract. So, as you must have read in your previous sessions of basic income definition, income has to be recognized only when we feel that the definition of income is getting met. There's a probability to for the income to come to you, and you're also in a position to reliably measure all the costs. And expected losses, if any, if you feel at any point of time, irrespective of the methods which we are going to discuss now, expected loss needs to be recognized immediately, irrespective of whatever methods you are following. Now, as I said that in the construction contracts, it is important for us to recognize income. That is the main issue here. The reason being, we cannot delay to recognize profits, or maybe we cannot stop to do the accounting till the entire construction contract is over. The reason being here, the timeliness is very important, which is your main enhancing qualitative characteristic. If we do not do anything for a construction contract, for example, which is going on for 5 years, then we do not know what is happening in the contract. This is the reason we try to do IS 11 method of accounting, and reliable estimate of your revenue and cost is of extreme importance for this particular accounting standard. But then we understand how to account for the two different types of contracts. For both the methods, we can broadly use two kinds of method to account for the same. There are two types of contracts. For both the types of contracts, we can use two methods, stage of completion or the completed contract method. Now, to take a decision on which method to follow, stage of completion or a completed contract method, first of all, I would like to tell you by the decision box. What is the decision box? Which helps us in take a decision in a particular question in exam. If it is not clearly mentioned how to do the accounting, you need to go by this decision box. First of all, the first step is we need to focus on whether we are in a position to measure the outcome of the contract reliably. Broadly speaking, for all practical reasons, by outcome in this particular decision box, we would be referring to the percentage of completed work so far on the contract. For example, in the first year, if you feel you have a reliable estimate that I have completed 20% out of the 100% of the contract, then probably I would go for only 20% as the reliable estimate. This percentage is quite important even from the exam point of view. Either the percentage would be clearly specified or there would be other methods mentioned in the question by which you will be in a position to calculate the percentage. If I am in a position to calculate the percentage of work completed so far, yes, I have a reliable estimate, I go for the stage of completion method. How to account for it numerically, we'll see later. But the most important thing for us to understand, we have to find out whether we are in a position to refer to the percentage of work completed so far in a reliable manner or not. If you see you can, then yes, you use the stage of completion method. If you feel you cannot, then you go for the completed contract method. So can I summarize like this, that there are broadly two types of contracts, fixed price and the cost plus contract. But when it comes to accounting for both these kind of contracts, we can use two kinds of methods. In both the methods, the first step is to see whether we have a reliable estimate of the outcome of the project. By practical solving purposes, by outcome we are referring to the percentage of work completed so far. If you are in a position to determine that percentage, yes, use stage of completion method. If you are not in a position to do that, you do the completed contract method. In any kind of a question, the first step is to identify whether you have a reliable percentage or not, and accordingly, you would have to see which method to apply. The numerical accounting we will see soon. Now we come back to the basics of two types of contracts. All these things mentioned on your screen are that about the reliability of the fixed price contract or the cost plus contract. You have to measure the revenues and the cost reliably. If you notice, these things are also your basic definition of income related characteristics. In simple terms, in a fixed price contract, since the revenue is already fixed, you should be in a position to measure the revenues more reliably. However, in a cost plus contract, you should be in a position to measure the costs more reliably. It makes more sense practically as well, because in a fixed price contract, you already know how much are you going to get. Whereas in a cost plus contract, you should be in a position to know what are the kind of expected costs you are going to incur on the construction contract. So now we come down to the numerical piece of these two types of methods, and we try to see a question and how to do the accounting. Here we have a company which has a fixed price contract of $16 million to be completed over 4 years. They have given you the schedule of the costs already incurred and the expected costs for each year. We will follow a step-by-step procedure to find out how much we have to account for every year. As I said again, we are not leaving accounting for the end of the construction contract period. The reason being, we have to understand that timeliness is of key importance here in this type of a contract. We cannot leave ourselves in the dark to understand after 4 years what is happening. We need to know on a year-to-year basis how are we performing on our contract. These are the step-by-step procedure on each of the methods that we are going to follow. Step 1 is identify which method to apply. For instance, let's assume in this case the percentages are already given to you. In the first year we have 20% completion, second 70%, third 90%, and finally in the fourth year 100% project is complete. So we have identified which method to use. We go back to the decision box. We are in a position to estimate the outcome reliably. So we go to the stage of completion method. Else, we would have used the completed contract method. The step 1 is always identify which method to apply. Then, if it is a stage of completion method, there will be certain other steps. We need to identify the total revenue of the contract. In this case, we are in a position to do that because it is a fixed price revenue contract. Okay, so we find out what is the total revenue, $16 million. If it is a cost plus contract, you can have an estimate of the total revenue to be expected on the contract. Then we identify the percentage of completion for each year. For example, in year 1, we see in the table that we have almost completed 20% of our total project. We have incurred $3 million in the current year. Therefore, total at the end of year 1 is $3 million. We are expecting another $7.6 million to complete the entire project. That means the expected total cost for the entire project is $10.6 million at the end of year 1. Now, since these are long-term contracts, there could always be a slight change in the estimation in the costs. But you have to make sure at all points of time you are not expecting a loss. If at all a loss is expected, immediately account for the loss irrespective of the method you are following. Okay, so the total expected costs at the end of year 1 are $10.6 million. We have completed 20%. We already have a total revenue of $16 million. So what we do is, at the end of year 1, since it is a stage of completion method, we take 20%, which is our reliable outcome, multiply the 20%, the percentage of reliable outcome, with both the construction revenue as well as the construction expected costs. We have completed 20% of the project, so we can successfully assume that we have earned 20% of the total revenues and we have also spent 20% of the total costs approximately. That is how we do the accounting for stage of completion method. So accordingly, we recognize $3.2 million of revenue in the first year, $2.12 million of expenses in the first year. Therefore, the profit for the first year is $1.08 million. I hope I'm clear with this one. We keep on repeating the same procedure year on year till the time we reach the final year of completion. In the second year, the percentage is 70. In the third year, the percentage is 90. You keep on doing this process till the time you come down to the final year. Only one thing you need to remember in time. In the second year, 16 into 70% is $11.2 million. Since we are doing a cumulative kind of an accounting, it means that at the end of year 2, total revenue should be recognized is $11.20 million. Since we are doing an cumulative accounting, 16 is for the entire 4 years, not just for the year 2, isn't it? So by year 2, total you have completed is 70%. How to interpret it practically is 20% was already completed in the first year. That means you must have done another 50% in year 2. That is how the 70% is coming. This gives me a very important accounting concept that $11.2 million is the total aggregate revenue which should come in the books at the end of year 2. Out of this $3.2 million you have already recognized in the first year. That means I would be only recognizing the balance of $8 million in the second year. As I said, since we do a cumulative accounting, $11.2 million is something which you should show in the books at the end of year 2, total for both the 2 years. So how can I do that? I already have 3.2 in the books. I show another 8. So I get a total of 11.2. It is something like, for example, you have 7 chocolates in hand. Your mother says you need to show 12 at the end of the day. So that means you need to show 5 more. That is the logic. If you have 7 chocolates, you need to show total of 12. So what I do is I do 5 more accounting. So I already had 3.2. I need to show a total of 11.2. That means I need to show only another 8 at the end of year 2. Similarly, for the expenses also, we follow the same procedure. These steps will help you understand whatever is to be done on a year-to-year basis. These are the same steps of what I am speaking in person. Actual billing in the stage of completion method, or for that matter in IS 11 construction contracts, actually how much you are billing to the client or how much you are receiving in cash from the client are not really important. We follow the standard procedures of either stage of completion method or the completed contract method. And one more tip I would like to give in FR is that you need to physically solve down all these things with a pen and a paper, or whatever method of solving is comfortable to you, because just looking at the questions and not trying to solve them physically doesn't really help. You get lost. Looking at it might look very easy, but then when you physically solve it, then you are more confident that yes, I have got the concept. We do this till the end of the 4th year. In the 4th year itself, the total percentages have been attained. The project is complete. So it is in this year you will be recognizing $16 million of full revenue and $10.7 million of expense. If you see at the end of year 1, we were expecting only a $10.6 million of expenditure. However, it has changed from year 2 onwards. This is fine and acceptable as long as your project is still profitable. You're not expecting any kind of losses on the project. So at the end of year 4, out of 16, you must have already recognized $14.4 million of revenue. This is the reason you are left with 1.6, and similarly for the expenditure, you are to recognize only 1.07. If I add the profit for all the 4 years, it will be 5.30. Up to year 3, I have already recognized 4.77 plus 0.53 for the year 4. Total profit at the end of year 4 is $5.30 million. So this was how we calculate the numerical accounting for the stage of completion method. These steps would help you to understand how to do the accounting. Now we move down to the completed contract method. In completed contract method, the logic is a bit different. Here what happens is, you remember in the decision box, we choose the completed contract method when we are not in a position to just look at and find out what is the reliable estimate of any project. Now here we follow a little bit of a conservative accounting. Since we are not in a position to follow or find out any kind of a reliable percentage, what we do for such kind of contracts is we follow the completed contract method, wherein we follow the concept of expense equal to revenue. Try to understand the logic behind the setters of the standard behind this. I am not in a position to find out how much work have I completed. It will be inappropriate for me to recognize any kind of a profit in this condition. Now, zero profit, zero loss is what I am trying to maintain in my books. But expenses I have already incurred. What I am not really sure of is how much revenue have I earned already. So the safest bet to keep zero profit is to put revenue equal to expenses, so that I have a zero profit in the books and I am a little bit conservative on recognizing a profit. Reason being, I am not really sure on the percentage of outcome in the contract. This is the reason for this completed contract method. I have to get a zero profit. I am following a little conservative accounting. This is the reason whatever expenditure I have done, an equivalent amount of revenue is recognized till you reach the final year. Why? Because expenses, whatever you are incurring on a year-to-year basis, is something you will already be aware of. What you are not aware of is how much work you have completed. So out of the total revenue, how much you have earned. This is the reason I want to keep zero profits. So the safest bet to do that is expense equal to revenue. In the first year, if you look at the table, you have incurred an expense of $3 million, in the second year 3.3, in the third year 2.1, and in the fourth 2.3. So what we do is we follow in the first year expense equal to 3, so revenue also equal to 3, so that profit equal to 0. In the second year, you can follow the cumulative approach as I taught in the stage of completion method, or you simply know that I have spent 3.3 in the second year, so revenue and expense both have to be 3.3. Similarly for year 3 as well. Only in the final year, I know that the project is 100% complete. I am still having a probability that I will get the revenue. I am not in a position of a loss. So in the final year only, I recognize the full revenue of $16 million and the full expense of $10.7 million in one shot. Why? Because in the final year, now I'm quite certain that the project is complete and I'm not in a position of a loss. So till the final year, you have already recognized 3 plus 3.3 plus 2.1. That means $8.4 million of revenue and expense each. So the balance of revenue and expense you can find out, and accordingly you will have a profit of $5.3 million. To conclude, if you notice, total profits recognized under both the methods shall be the same. In the previous stage of completion method also you had a profit of 5.3. Here also you are going to have a profit of 5.3 only. The only difference in the two methods is how do we recognize on a year-to-year basis. In stage of completion method, I'm quite sure of how much is my revenue earned because I know how much of work have I completed. Okay, so it is a kind of an ethical and conservative accounting as well. If I know how much I have earned, then I am in a safe position to recognize a profit. If not, then it is incorrect for me to recognize a profit. So I split up this 5.30 profit in 4 years in the stage of completion method where I am a little certain. However, in the completed contract method, I am not certain till the final year comes. This is the reason entire $5.3 million is recognized in one time in the last year itself. So this is about IS 11. You can also look up for journal entries in the next session at which we plan. Okay, I hope IS 11 was clear to you. Now, many people ask me what is FxMantra. So just a quick background about us. We are a finance and education specialist. We are ourselves qualified CA and CPAs, and we also have people from London Business School. We have a major focus on training for corporate professionals, skill development, education services. You can visit our website for more details. Thank you, and I hope the session was useful to you.